Welcome to Value Vest Daily. In the absolute gold rush for AI, you know the companies selling the picks and shovels are the ones getting filthy rich. And today, we're diving deep into two of the biggest shovel sellers out there. NBIS Group, that's ticker NBIS, and CRWV, ticker CRWV. As of April 15, 2026, we're looking at NBIS around $167 a share and CRWV at about $119. Both have just seen their stocks go completely parabolic, but the big question is there any fuel left in the tank?
So let's just start with NBIS. I mean, look at this number. In just 1 year, it's up 680%. That is the kind of explosive, almost unbelievable growth that absolutely turns heads, but it also raises some serious questions.
And then you've got CRWV. Its story is just as impressive, in its own right. It's more than doubled since its IPO just last year. Now, these are the kinds of gains that investors literally dream about. But it's exactly this kind of rocket ship rise that means we have to take a much, much closer look under the hood. So yeah, that's the core question we're tackling today. Are these stocks flying way too close to the sun? Are they just set for a major, painful pullback? Or is this just the very beginning of their total dominance in the AI infrastructure space? Let's break it down and find out.
Okay, here's our game plan for getting to the bottom of this. We're going to start by asking that big question. Are these AI giants overbought, or is this a huge opportunity? Then we'll dig into the fundamentals. First for the hypergrowth challenger, NBIS, and then for the established leader, CRWV. After that, we'll analyze the technical red flags popping up on the charts, and finally, we'll put it all together and deliver our final verdict.
All right, just a quick but important reminder, this is all for educational and informational purposes only. It is not financial or tax advice. Please always do your own research before making any investment decisions. Okay, let's get into it.
Let's kick things off with NBIS, who I'm calling the hypergrowth challenger. So what is this company? Well, it's basically the international spin-off of the Russian tech giant Yandex. Now it's laser-focused on one thing: providing the raw GPU cloud power that all these AI models are so hungry for. They're a true global player with a growth story that is just, well, off the charts.
Okay, the key thing to see here is the acceleration of their growth. A 351% year-over-year revenue increase is already mind-boggling, right? But look at their most recent quarter. It was up 547%. The growth is actually speeding up, and just as importantly, they're starting to become profitable on an operational basis, guiding for a really healthy 40% adjusted EBITDA margin this year. So, what's next? Well, get this. Their guidance for this year is a monumental leap to over $3 billion. That's a six-fold increase from last year. And they claim this isn't just some pie-in-the-sky projection. It's based on actual signed contracts. That suggests this insane hypergrowth is absolutely set to continue.
So how in the world are they pulling this off? Well, it helps when you have friends in very high places. We're talking major league partnerships. A massive $27 billion deal with Meta gives them immense scale. Then you have a strategic $2 billion investment from NVIDIA itself. Now that's not just cash, that's a huge vote of confidence and a partnership to co-develop new tech. With their capacity already sold out into early next year, demand is clearly just through the roof.
So it's really no surprise that Wall Street is incredibly bullish on this story. The consensus is a strong buy, with price targets suggesting the market really believes in this explosive and, more importantly, validated growth narrative. Okay, now let's talk about CRWV, ticker CRW. If NBIS is the fast-growing, scrappy challenger, then CRWV is the established heavyweight champion of the world. They are the clear leader in this space, especially in the US, and they are operating on a completely different scale. And you can see that scale right here in the numbers. Over $5 billion in revenue last year, and they're guiding for up to $13 billion this year. Now, while the percentage growth isn't as eye-popping as NBIS, the sheer dollar amount is staggering. They're adding more revenue in 1 year than most companies will ever see in their entire lifetime.
The single most important number for any CRWV investor is this one right here, a nearly $67 billion backlog. Let that sink in for a second. This is contracted revenue, already locked in for years to come with clients like Meta and OpenAI. It provides a level of certainty and visibility that is almost unheard of in the tech sector.
But there's always a catch, isn't there? This kind of world-dominating growth is incredibly expensive. CRWV is burning through cash and has taken on significant debt. For every single dollar of revenue they plan to make this year, they have to spend about $2.60 on building out these massive data centers. This introduces a huge amount of execution risk. If anything goes wrong with those build-outs, they could be a big problem.
And this whole risk-reward profile is perfectly reflected in the analyst consensus, which is a more cautious, moderate buy. They absolutely love the demand story and that backlog, but they are keeping a very close eye on the balance sheet. The average price target is sitting right around $124.
So the fundamental stories for both companies are incredibly compelling, but they come with different flavors of risk. Now let's totally switch gears and look at the charts, because the technical picture tells a very, very different story. One of stocks that look, frankly, a little tired and vulnerable right now.
Looking at the technicals here, both stocks are flashing some pretty bright warning signs. The Relative Strength Index, or RSI, basically measures how fast and how far a stock has moved. Think of it like the speedometer on your car. Anything over 70 suggests you're kind of pushing it. Well, both NBIS and CRWV are sitting above 70, which in trader speak means they're overbought. To put it simply, the momentum indicators for both of these stocks are screaming at the top of their lungs, "You've gone too far, too fast." Now, a strong stock can stay overbought for a while for sure, but this level of extension often leads to a pause or even a pretty sharp drop as investors decide to take some profits off the table.
Now, crucially, a correction here isn't necessarily a bad thing for long-term investors. A healthy 10 to 20% pullback would let that momentum cool off, it would reset the indicators, and it could offer a much better entry point for those of us who believe in the long-term fundamental story.
All right, it's time for the final verdict. We have the explosive, unproven growth of NBIS versus the massive, de-risked scale of CRWV. And on top of that, both have charts that look like they're ready for a serious breather. So let's put them head-to-head and see how they stack up.
CRWV clearly wins on sheer size and revenue visibility, and that's all thanks to that monster backlog. But NBS, well, it takes the edge on financial health with a much clearer path to profitability and a much cleaner balance sheet. But the biggest difference, and you can't ignore this, is valuation. You're paying a huge premium for NBIS's growth at 77 times trailing sales, while CRWV looks much more reasonable at 12 times sales.
And this really frames the choice for you as an investor, right? With NBIS, you're making a bet on the high upside disruptor. It's a high beta stock that's likely going to move way more dramatically than the overall market. With CRWV, you're choosing the established leader, where that massive backlog significantly de-risks the future. The financial profiles highlight the exact same trade-off. NBIS offers you a much safer feeling balance sheet with less debt and leverage. CRWV, on the other hand, offers a much cheaper-looking stock, but it comes with the risks of higher debt and that massive capital spending.
So which one is the better buy? Honestly, there's no single right answer. It really depends on your personal investment style and your tolerance for risk. If you want the safety of massive scale and a pretty much guaranteed revenue stream, CRWV is probably your pick. But if you're chasing that maximum percentage growth and you prefer a cleaner balance sheet, even if it means paying a higher price, then NBS is your choice.
So what's my take? I think both of these companies are fantastic, totally legitimate ways to invest in the AI boom. They're both high conviction plays for the long term. But you just can't ignore the charts. At today's prices, both look extremely overbought, and the margin for error is razor thin. For anyone looking to put new money to work, the most prudent move seems to be patience. Waiting for that 10 to 20% pullback could provide a much safer entry point into these amazing stories.
So there you have it. You've got these super strong fundamentals, a massive AI tailwind pushing them forward, but charts that are absolutely screaming for a break. So now I want to turn it over to you. What's your plan? Are you looking to buy a potential dip? Are you holding on for dear life through the volatility? Or are you just staying on the sidelines and watching the show?
If you found this deep dive valuable, please do us a huge favor and subscribe, like, and share ValueVest Daily. We're here to provide daily learning opportunities to help you before you put your hard-earned money to work.
And one more thing. Please drop a comment below and let us know if there are any specific high-risk, high-reward opportunities you want us to deep dive into next. We read every single one. Thanks for tuning in.